Something is happening right now that could touch every single one of us. 2 days ago, July 28, 2026, South Korea's KOSPI index crashed 10.8% in a single day, tripping its 8th circuit breaker of the year. And the next day, July 29th, it happened again. 2 days of circuit breakers in a row, the first time in the history of the Korean market. Next door, Japan's Nikkei fell nearly 4%, breaking below 62,000. Now, if you think this is Korea's problem or Japan's problem, nothing to do with you. Give me the next 10 minutes. Because for the last 30 years, Korea has almost always been the first red light to flash before every crisis that went on to shake the world. 1997, 2000, 2008, 2020, 4 for 4, not one miss. And right now, this is the 5th. This isn't a crystal ball. It's a historical pattern with a frighteningly good track record. Let me take it apart, layer by layer. Start with Korea. The KOSPI closed at 6,023, down 732 points, a drop of 10.8% in one session. Here's how the day unfolded. At 9:06 in the morning, 6 minutes after the open, a sidecar kicked in and froze program selling for 5 minutes. By 10:13, the market was down more than 8% for over a minute. That triggered a full circuit breaker, halting the entire market for 20 minutes. And at 12:01, the junior KOSDAQ board halted too. In a single day, both boards stopped trading. The two chip giants let it down. SK Hynix fell about 14%, Samsung about 13.5%, and here's why that matters. Those two stocks together are more than half the entire index. When they go, the index goes with them. Foreign investors dumped a net 5 trillion won, roughly $3.4 billion, in one day. And it didn't stop there. The next day, July 29th, the KOSPI fell another 6%, down as much as 12.5% intraday, hitting a circuit breaker for the second straight day. In Japan, Tokyo Electron fell nearly 11%. Memory giant Kioxia briefly hit limit down. SoftBank slumped. The whole semiconductor chain broke. This is not an ordinary technical pullback. This is a systemic sell-off, ignited in semiconductors, accelerated by leverage, and spreading across the whole market. You might say, coincidence. So let's open the last 30 years of financial history. 1997, the Asian financial crisis. The won collapsed from 800 to nearly 2,000 per dollar. The KOSPI fell more than 70% on the year, and Korea's foreign reserves ran dry. And once Korea broke, barely a couple of weeks later, U.S. stocks broke down too, and a global bear market swept every market. 2000, the dot-com bubble. Early that year, Samsung and SK Hynix cut their revenue outlooks, and Korea's chip sector topped out a full 3 months early as money quietly drained out of tech. By the time the Nasdaq began its epic collapse, down nearly 80% on the year, Korea had already finished the first leg down. 2008, the subprime crisis. While the U.S. was still arguing over whether subprime would spread, and Wall Street insisted it was contained, Korea had already surrendered back in July. Foreigners kept selling, the won kept falling, and Korean banks' dollar funding costs spiked as the market slid into a dollar shortage first. A month and a half later, Lehman collapsed. 2020, the COVID crash. In late February, U.S. stocks were still drifting near record highs, and plenty of people figured the virus was a faraway problem. But Korea had already blown up. Foreigners sold for days on end. The KOSPI fell nearly 35%, halting repeatedly. 3 weeks later, the US began its own four-circuit breaker plunge. 4 crises, 4 different triggers, 1 underlying logic. The moment global liquidity tightens, capital pulls its money home, and Korea is always the first to get drained. At this point, you're asking, why Korea every time? Is there some fatal flaw in its economy? The core isn't how big Korea's own problem is. It's the self-preservation instinct of global capital. The moment those big Western banks, hedge funds, and asset managers get short of cash at home, they will not sell their core home assets first. Their first move is always sell the overseas book, pull the money home, put out the home fire. The priority is clear. Protect the core, drop the periphery, sell what's liquid first, touch the hard-to-sell stuff last. This has little to do with whether Korea's economy is healthy or whether its market is in a bubble. And Korea fits the profile of first to be drained perfectly. 1. Its capital markets are wide open, almost no currency controls. You can sell today and wire the cash out today. 2. Foreigners hold over 30% of the market, and Samsung and SK Hynix are among the most liquid names on earth, so even huge sell orders feel fast and don't get stuck. 3. The economy is deeply tied to exports and the global cycle. It flies in the upswing and falls fastest in the ebb. Put simply, Korea is like global capital's emergency cash reserve parked overseas, left there to earn a return in good times, and the first ATM anyone hits when they need money at home. So when Korea cracks first, that itself is the clearest signal that global capital has started pulling money out of everywhere. The tide goes out here first, and the pressure then travels down the funding chain and the supply chain, layer by layer, from export economies to commodities, from Asia to the West. A lot of people quietly assume, if it falls far enough, the Fed will just rescue it, a V-shaped bounce, like 2020. But this time, the 2020 script probably can't run. At least 8 things have changed. The trigger. 2020 was COVID, an external shock, sharp but fast, and once it passed, confidence came back. This time, it's an AI bubble cracking from the inside, with the market itself now questioning whether all that AI spending will ever pay off. When confidence collapses from within, it heals far slower than an external shock. The leverage. 2020 was mostly institutional leverage, orderly, with a process. This time it's retail leverage, through leveraged ETFs, and Korean margin balances hit a record 38.6 trillion won. Retail deleveraging isn't orderly, it's a stampede, and that's the accelerator this time. I'll pull it apart in a moment. Concentration. Samsung plus SK Hynix are now more than half the KOSPI. The index is hostage to 2 stocks. Semiconductors crack, and the whole market cascades. Geopolitics. 2020 was relatively calm. Now the Middle East is escalating. Brent crude sits in the $90 to $100 range, with upward pressure, and Japan and Korea are among the biggest energy importers on the planet. High oil squeezes corporate profits directly. China. China's memory maker CXMT just went public, and its technical progress strikes right at the valuation foundation of Korea's chip duopoly. On the news, SK Hynix and Micron sold off together, and Korea itself, its central bank hiked a quarter point to 2.75% on July 16th, pushing funding costs up further. But the one that matters most is the Fed. Hold that thought. If I could keep only one part of this whole thing, it'd be this, because it answers the question, why did Korea fall faster and harder this time than in any prior crisis? The answer is single stock leveraged ETFs. On May 27, 2026, Korea's government approved 16 two-times leveraged ETFs tied to Yes, Samsung, and SK Hynix, under the banner of letting citizens share in the AI boom. What happened? Money poured in, and by late June, Korean margin balances hit that record 38.6 trillion won. Then, in July, policy did a 180. Higher margin requirements, a ban on new single-stock leveraged products, and the base rate pushed to 2.75%. Leverage suddenly got expensive, and accounts were forced to deleverage. That's when the death spiral started. Here's the mechanism. A 2x ETF targets twice the stock's daily move, so to keep that exposure, it has to rebalance every day. When the price falls, it has to sell. The ETF sells, the price drops further. The price drops. More leveraged accounts get margin called. Retail can't meet the call. Positions get forced liquidated. The forced selling drives the price lower still. Lower price, the ETF has to sell again. Once this loop starts, without outside intervention, it does not stop on its own. There's a mass trap inside it too. A stock that falls 10%, then rises 10%, ends up roughly flat. But a 2x leveraged ETF loses about 4% because each day compounds off a lower base. The longer it drags on, the more it bleeds. How bad did it get? By mid-July, over 1.2 million leveraged accounts got margin calls, and 320 to 360,000 of them were fully wiped out, liquidated to zero. Forced liquidations from May through mid-July ran about 2.3 trillion won. The biggest of the 16, the Codex SK Hynix 2x ETF, fell 45 to 47% from its high, even though SK Hynix that quarter reported record profits. Goldman's Seoul team put it plainly, this isn't deteriorating fundamentals, it's a concentrated unwind of single-stock leveraged ETFs. And if you remember China's A-shares in 2015, a government-cheered leverage bull market, then a policy reversal, then a crash. Korea this year is running almost the exact same story. A lot of people think, Korean retail blowing up, so what? I don't even own Korean stocks. That's exactly the problem. Korean retail didn't only buy Korean stocks. Through 2 years of the AI bull, they loaded up on Japanese chips, Taiwanese stocks, and US stocks. So when they get forced liquidated at home and desperately need cash for a margin call, they don't sell selectively. To them, everything is a sellable asset. They dump it all, indiscriminately. That's the first domino in a cross-market chain. Seoul blows up. Korean retail is forced to sell everything. Japanese stocks, Taiwan, Asia-Pacific holdings fall with it. Even Bitcoin gets sold. Nasdaq futures come under pressure during Asian hours. US stocks open weak, and that negative signal travels back to Asia overnight, so the next day Japan and Korea fall again. A trans-Pacific feedback loop closes. Right now, there are at least 5 parallel channels reinforcing each other. Cross-market leveraged selling, the Nasdaq and Asian chip feedback loop, a yen carry trade unwind, where rising Japanese yields forced the borrow yen buy the world crowd to close out, an oil shock squeezing Japanese and Korean profits, and passive funds and index ETFs selling mechanically, amplifying one-way pressure. These 5 aren't independent. One breaks and the other 4 accelerate, which is why Korea's circuit breakers aren't a punchline. They are a trigger for systemic risk. Okay, we've covered what's happening and why. Now the big question, how does it end? And the core of the answer is a single variable, the Fed. The 2020 script was beautiful. Crisis hits. The Fed slashes to zero, unleashes unlimited QE. The market V-bounces, and the party keeps going. But the cost of that operation was inflation. Since 2020, U.S. inflation has run above the 2% target for years, and core PCE now sits at 3.4%, the highest since October 2023. With inflation that high, would the Fed dare flood the system like 2020 again? Reality has already answered. Just yesterday, July 29th, the Fed delivered its decision. It held at 3.5 to 3.75%. But the real signal isn't the hold. It's the split inside the room. 3 officials dissented. And what they wanted wasn't a cut, it was a hike. The new chair, Kevin Warsh, was pointedly hawkish, saying he won't hesitate in the fight against inflation. Going in, even Citadel had bet on a surprise hike. Translate that. In the middle of an unfolding crash, the Fed's debate wasn't how to rescue the market. It was whether to hike. It's not that it doesn't want to help. It's handcuffed by inflation. Cutting means admitting inflation is out of control. Hiking means pouring fuel on a market that's already crashing. The unlimited ammo of 2020. This time, it's probably not there. The market may have to face this one alone. Based on all of that, here are 3 paths. And to be clear, these are probability judgments, not predictions, and definitely not investment advice. The first, a soft landing, roughly 1 in 5. The Fed signals a clear pause. Samsung and SK Hynix earnings beat and steady the chip sector. The Middle East calms and oil eases, and Korea deleverages in an orderly way without spilling over. The nicest path, and the least likely. The second, a violent but contained washout, roughly 45%, and the base case. The Fed holds but stays hawkish. The market keeps pricing hikes. Korean and Japanese leverage keeps unwinding, and chip valuations get completely reset. SK Hynix's forward price to earnings has already fallen below 4. That's bankruptcy-level pricing. But a market in panic never listens to reason. This washout is brutal, but it doesn't escalate into a global systemic crisis. Asia takes serious damage. The global financial system doesn't freeze. The third, a systemic global crisis, roughly 35%. The conditions: the Fed hikes by surprise, or the Middle East spirals and oil spikes to 120, or Korea's leverage stampede blows a hole in some large financial institution's liquidity. Any one of those, and a local washout can escalate into a global storm, from Korea to Japan, from Asia to the West, with the feedback loop going out of control. Which path wins gets decided by a handful of moments over the next week. Samsung and SK Hynix earnings, the Fed's follow-through tone, whether Korea's new leveraged ETF rules, taking effect July 31st, trigger a fresh wave of liquidations, and the Middle East. Let me finish with 3 convictions. 1. Korea isn't having a problem. It's rerunning the warning script that has played before every global crisis for 30 years. 1997, 2000, 2008, 2020. 4 crises. 4 times Korea cracked first, a pattern that has never broken. This is the 5th signal. Clear evidence that global capital has started pulling money out of everywhere. 2. The driver this time isn't simple panic. It's a triple resonance, a leverage stampede, plus cracking faith in AI, plus a geopolitical shock. That 38 trillion won margin balance and the leveraged ETF death spiral are an accelerator no prior crisis had. Add China's CXMT breakthrough striking at the foundation of Korea's chip valuations, and this risk structure is more complex than any crisis before it. 3. The 2020 Fed rescue probably can't be repeated. Inflation at 3.4, oil near 100, 3 officials pushing to hike. The Fed isn't looking for a reason to rescue the market. It's looking for a reason to raise rates. The market may be on its own. And I'll leave you with one framework. Watch 3 signals. Does Korea's KOSPI keep hitting circuit breakers? Does Japan follow it down? Does the US market start to break down? If those 3 confirm in sequence, the escalation chain from a local crisis to a global one has closed the loop. And historically, every time that chain has run its course, the world got a real financial storm. The tide is going out in Korea. The only question left is how far it goes. That's it for this one. Thanks for watching. This is information and analysis, not investment advice.